Let me tell you something most traders have never heard before. After analyzing thousands of real trading accounts, not just retail but also at the institutional and prop firm level, we discovered a troubling pattern. The single biggest psychological risk for consistently profitable traders is not fear or discipline, it is overconfidence. And here's the kicker. Studies from the University of California showed that overconfident traders underperform the market by almost 40% on average, even when they've had streaks of prior success. Think about that. Nearly every trader who's been on a winning run has walked right into the exact mental trap that will sabotage them most, believing they're more skilled than the market itself. Now, here's what will surprise you even more. In the behavioral finance literature, there's something known as the illusion of control. Psychologists like Ellen Langer found decades ago that people start to believe their skill determines outcomes even when randomness is the bigger factor. In trading, this leads directly to pushing size, increasing risk, and straying from proven strategies with devastating impact. We tracked traders who had three or more consecutive winning months, and nearly 8 out of 10 of them increased their position size dramatically the following month, only to suffer their largest drawdowns right after. Success flips into overconfidence. Overconfidence leads to risk blow up, and the cycle continues. Sound familiar? But here's the nuance nobody talks about. Even professional traders at hedge funds, people with millions in backing, fall prey to this exact pattern. I saw it firsthand. A top performing analyst at a major New York firm had a brilliant quarter, outperforming benchmarks across the board. The next quarter, he began fading all his rule based stops, believing he was finally seeing the matrix. Within 2 weeks, all those gains evaporated and more. The data doesn't lie. Overconfidence is agnostic to experience level. What sets apart the real elite, the top 1% of traders, is not that they never get overconfident. It's that they have mechanisms to catch and correct it faster than anyone else. Let me share something from a famous study by Odeon and Barber published in the Journal of Finance. Tracking tens of thousands of brokerage accounts, they found that traders who scored highest on self rated skill also had the most erratic results and poorest overall returns. So, what really makes an elite performer? Not self belief, but self awareness. Most trading educators will tell you to control your emotions or follow your rules. But that's not enough. The secret is to measure and audit your psychological states with the same rigor you apply to your P&L and risk metrics. Let that sink in for a second. When's the last time you ran a psychological audit before increasing your position size or after your best day in the market? Almost nobody does this, and yet it's the only way to break free from the overconfidence trap for good. Let me give you a specific actionable framework you can use right now based on research from the London School of Economics and work I've done analyzing institutional traders. It's called the confidence calibration process. There are three components. First is statistical feedback. After every string of wins, you run a deep dive on your trade log dissecting how much outcomes really depended on skill versus volatility or sheer luck. Second is peer debiasing. Before you adjust your risk, you share your new trade idea and recent results with a trusted fellow trader, someone who's incentivized to give you honest, brutal feedback. Third is the rule reinforcement loop. This means revisiting your written trading plan line by line and forcing yourself to justify every deviation you're tempted to make after a win streak. These three steps are non negotiable if you want to escape the classic overconfidence spiral. Now, here's why most traders never use this framework. It exposes uncomfortable truths about how much of their success was market driven rather than skill based. When we looked at the data, we found that traders who regularly engaged in confidence calibration outperformed their peers by a factor of two, not because they were more talented, but because they systematically limited the downside damage of inevitable overconfidence. It's not about avoiding being wrong, it's about limiting the cost of being wrong when your brain is telling you that you can't miss. Here's a story that really drives this home. One of my hedge fund clients had a remarkable 6 month period where his hit rate soared to over 68%. He started to believe he'd cracked the code and doubled his risk budget for the next quarter. Sound familiar? Within 1 month, he hit his max drawdown and lost 18 months of gains. When we did a psychological audit, we realized he'd abandoned his risk limits only after his winning period. His execution discipline collapsed, all from unconscious overconfidence. We integrated the confidence calibration process into his weekly routine. Within 6 months, drawdowns plummeted and his returns became steady. Not explosive, but consistent. And that's what institutions really value. But wait, here's the institutional twist most people miss. At prop firms and elite hedge funds, traders are now subjected to regular psychological assessments, not just on their risk taking, but on their decision making after major wins. In fact, some of the top quant shops are using AI to track language and behavioral shifts in trader communication logs as early warning signals for creeping overconfidence. If you want the reality of trading at the top level, that's it. The competition isn't just tracking the market, they are tracking their own minds at a level 99% of retail traders are still ignoring. Let's pattern interrupt here because I want you to ask yourself honestly, do you have a process to catch your own overconfidence before the market does? Are you aware of the telltale signs, the growing urge to increase size without justification, skipping rule based stops, assuming past success predicts future outcomes? I promise you, the best traders don't trust their gut when they're on a hot streak. They become even more skeptical of their intuitions because they know the exact moment they become convinced of their genius is statistically when they are most vulnerable. And this is where the research becomes actionable for you. After seeing these patterns across thousands of traders, we developed the Decred score, an AI powered assessment that benchmarks your psychological blind spots across the four pillars of elite trading performance. First, strategy consistency. Are you sticking to edge or improvising when you feel invincible? Second, risk management. Are your position sizes discreetly creeping higher after a win streak? Third, execution discipline. Are you actually following through on your planned exits even when you feel unbeatable? And fourth, scaling readiness. Can you increase size responsibly or does it always follow the emotional highs of recent gains? Our data shows that 93% of traders who suffer major blowups have measurable breakdowns on these four score pillars right after streaks of success. Let that statistic rewind in your mind for a moment, not after losing, but after winning. This is why a psychological assessment like the Decret score is no longer optional. If you are serious about performance, you need a mirror that reveals your true mental patterns, not just your trading results. You might be wondering, is it really possible to measure overconfidence in real time? Here's the answer from our research and thousands of completed assessments. Yes, and it is shocking how quickly invisible psychological vulnerabilities become visible through structured, scientific self analysis. Elite traders who master these four pillars are able to anticipate when their own performance curve is about to invert. they get early warning signals, not just from the market, but from themselves often before risk spirals out of control. Let me leave you with this. Imagine you could map your psychological strengths and weaknesses as precisely as you track your win rate or average risk reward. Imagine you knew with scientific precision the exact moments your own mind starts scaffolding the overconfidence trap. That's the advantage institutions are buying with millions in research and behavioral analytics. There's a reason we now require every top trader to run a decrete assessment at vault.decrete.com because you can't fix what you can't see, and the hardest psychological patterns to spot are always the ones that emerge in success, not failure. So, if you want the edge of real self awareness, if you are ready to break the cycle of success and sabotage, your next step is obvious. Take the Decrate score at vault.decrate.com, get your 4 pillar psychological profile, and join an elite community of traders who no longer let overconfidence destroy their performance. The best in the business make psychological auditing as routine as checking their positions. If you want to think, trade, and win like the elite, it starts by seeing what you cannot see on your own. Remember, in the markets, self delusion is always more expensive than any loss.